The 1MDB scandal. Let's start with perhaps the most brazen government theft in modern history. The One Malaysia Development Berhad scandal, or 1MDB, reads like a Hollywood thriller. And ironically, it actually helped fund one. In 2009, Malaysia created 1MDB as a sovereign wealth fund designed to boost the country's economy. The fund was supposed to invest in energy projects and real estate to benefit the Malaysian people. Instead, it became a personal piggy bank for some of the most powerful people in the country. The mastermind was Joe Low, a flamboyant Malaysian financier who somehow convinced Prime Minister Najib Razak to let him influence the fund's operations. Low created an intricate web of shell companies and fake oil venture deals to systematically loot over $4.5 billion from 1MDB. But here's where it gets really wild. Low didn't just steal the money and hide it away. He went on one of the most extravagant spending sprees in criminal history. We're talking about a $250 million yacht called the Equanimity, complete with a helicopter landing pad and a swimming pool. He bought penthouses in New York, mansions in Beverly Hills, and even a hotel in London. But perhaps most audaciously, Low used stolen Malaysian government money to finance Hollywood movies. Yes, you heard that right. The Wolf of Wall Street, the Leonardo DiCaprio film about financial excess and corruption, was partially funded by actual financial corruption. Low also financed Daddy's Home with Will Ferrell and Mark Wahlberg. The irony is almost too perfect. The money laundering operation was sophisticated. Funds were routed through Swiss banks, Singapore financial institutions, and American accounts. Each transfer was carefully disguised as legitimate business transactions. Goldman Sachs played a crucial role helping to issue bonds for 1MDB while their executives allegedly knew about the fraud. The House of Cards finally collapsed in 2018 when international investigations exposed the scheme. Prime Minister Najib Razak was voted out of office and later sentenced to 12 years in prison for his role in the scandal. His wife was found guilty of corruption and given a 10-year sentence. Joe Low remains a fugitive, believed to be hiding in China, but the legal consequences extended far beyond Malaysia. Goldman Sachs agreed to pay nearly $3.9 billion in settlements to Malaysia. Former Goldman banker Tim Leissner pleaded guilty to conspiracy and was sentenced to 2 years in prison. Swiss courts convicted Petro-Saudi executives Tariq Obaid and Patrick Mahoney, who helped facilitate $1.8 billion of the theft through fake oil deals. The scandal showed how easy it was for corrupt officials to exploit the global financial system when major banks were willing to look the other way for lucrative fees. By 2021, authorities had recovered over $1.2 billion in stolen assets, but billions more remain missing. The Russian laundromat. If 1MBD was audacious, the Russian laundromat was systematic. Between 2010 and 2014, this massive operation laundered at least $20.8 billion out of Russia, making it Europe's largest known money laundering scheme. The beauty of this operation from a criminal perspective was its simplicity. Russian criminals and corrupt officials needed to get money out of the country and make it look legitimate. So, they created a network of shell companies in Moldova and Latvia, two small countries with banking systems that were easier to manipulate. Here's how it worked. And let's say you're a Russian oligarch with $10 million in dirty money. You set up two shell companies, one in Moldova and one in Latvia. The Moldovan company loans money to the Latvian company. Of course, the Latvian company has no intention of paying back this loan, so the Moldovan company takes the Latvian company to court in Moldova. But the judges are corrupt and in on the scheme. They issue a judgment ordering the Latvian company to pay back the loan, plus interest, immediately. This court judgment makes the debt transfer look completely legitimate. The Latvian company then transfers the money to pay the debt, but instead of going back to the original Moldovan company, it gets wired to accounts in Western banks. The money has now been laundered through what appears to be a legitimate court-ordered debt payment. This fake loan and court judgment process was repeated thousands of times with different amounts and different shell companies. The corrupt judges in Moldova issued over 500 suspicious court judgments, legitimizing billions in transfers. The laundered money was then used to buy real estate in London, luxury goods across Europe, and to fund political influence operations. Some of the money even ended up in American banks, showing how Russian dirty money could penetrate the entire Western financial system. What made this scandal particularly damaging was that multiple Western banks processed these transactions despite obvious red flags. Banks in Latvia, Estonia, and even major international institutions saw patterns of suspicious transfers but continued processing them anyway. The scheme was eventually exposed by the Organized Crime and Corruption Reporting Project, OCCRP, in 2017. Their investigation revealed not just the scope of the laundering operation, but how it had been allowed to continue for years despite warnings from financial intelligence units and compliance officers. The Troika Laundromat. While the Russian laundromat was running its fake court judgment scheme, another massive Russian money laundering operation was quietly moving billions through a completely different method. The Troika Laundromat, operating from 2003 to 2013, used Russia's own investment banking system to clean dirty money. Troika Dialog was a legitimate Russian investment bank, one of the country's largest. But behind the scenes, bank insiders created a web of at least 70 shell companies in the British Virgin Islands. Through these companies, they laundered $4.8 billion in suspicious transactions, with total money flows reaching nearly $8.8 billion. The genius of this scheme was using the reputation of a legitimate bank to hide illegitimate activities. Troika Dialog had real business operations, real clients, and real regulatory oversight. This made it much harder for authorities to detect the criminal activity hidden within normal banking operations. The money laundering worked through fake consulting fees and phantom business transactions. The shell companies would invoice each other for non-existent services, creating paper trails that justified large money transfers. These fake consulting fees were then used to purchase luxury assets and real estate across Europe and America. But perhaps the most disturbing aspect of the Troika Laundromat was how it exploited vulnerable people. The shell companies needed official signatories and directors to appear legitimate. Instead of using the actual criminals, the scheme recruited vulnerable individuals, often people with addiction problems or financial difficulties, to serve as unwitting figureheads. These people had no idea they were fronting for a multi-billion-dollar money laundering operation. They were simply told they were helping with routine business paperwork. Meanwhile, their identities were being used to transfer massive amounts of dirty money across international borders. The laundered money funded an extravagant lifestyle for Russian elites. They bought luxury yachts, threw expensive parties in European capitals, and purchased prime real estate in London and New York. All of this was disguised through the complex web of shell companies and fake business transactions. The Troika Laundromat was eventually exposed in 2019 through a joint investigation by the OCCRP and other international media organizations. The investigation revealed internal bank documents and communications that showed how the laundering operation worked and who was involved. Danske Bank scandal. Just when you think money laundering scandals can't get any bigger, along comes Danske Bank with what may be the largest money laundering operation in history. Between 2007 and 2015, this Danish bank's Estonian branch processed an estimated $230 billion in suspicious transactions, mostly from Russia and other former Soviet states. To put that number in perspective, $230 billion is larger than the entire GDP of most countries. It's more than the annual economic output of Finland or New Zealand. And it all flowed through a single branch of a Danish bank in Estonia. Danske Bank's Estonian operation was supposed to serve non-resident clients, mostly wealthy Russians who wanted to access European banking services. But instead of conducting proper due diligence, the bank essentially operated as a washing machine for dirty Russian money. The scheme worked through shell companies incorporated in the UK, Cyprus, and New Zealand. These companies would open accounts at Danske Bank's Estonian branch, then move massive amounts of money through correspondent banking relationships with major international banks including JP Morgan, Bank of America, and Deutsche Bank. The money laundering scheme used correspondent banking relationships to move money globally. When a Russian shell company wanted to transfer money to London, it would instruct Danske Bank Estonia to make the transfer. Danske would then use its relationship with major international banks to move the money, often through multiple intermediary banks to obscure the money trail. This correspondent banking system meant that dirty Russian money didn't just stay in Estonia. It flowed through some of the world's largest banks, including American institutions. The money was then used to purchase real estate, luxury goods, and other assets across Europe and North America. The scandal finally exploded into public view in 2018, when journalists exposed the scope of the money laundering. The bank's CEO resigned and criminal investigations began in multiple countries. Former bank employees were arrested, and the bank faced massive regulatory fines. In December 2022, Danske Bank pleaded guilty to fraud charges in the United States and agreed to pay $2 billion in penalties. France also fined the bank €6.3 million in 2024. But the financial penalties were just the beginning of the consequences. HSBC and the Mexican cartels. Between 2006 and 2010, HSBC failed to investigate or report $881 million in transactions tied to Mexican and Colombian drug cartels, effectively becoming a financial partner to some of the world's most violent criminal organizations. This wasn't a case of sophisticated money laundering that was difficult to detect. HSBC bank employees literally accepted boxes full of cash from Mexican currency exchange houses. We're talking about hundreds of thousands of dollars in cash being deposited in boxes designed to fit perfectly through the bank's teller windows. The cash deposits were so large and frequent that the bank had to redesign its teller windows to accommodate the flow of money. The Mexican currency exchange houses, known as casas de cambio, were obvious fronts for drug cartel money laundering operations. These businesses had no legitimate reason to be depositing such enormous amounts of cash into HSBC accounts. But instead of questioning these transactions or filing suspicious activity reports, HSBC staff facilitated the deposits and helped move the money into the international banking system. Internal bank communications revealed that HSBC employees knew exactly what was happening. They joked about the cash deposits and even referred to some clients as obvious money launderers. Bank staff edited wire transfer notes to remove references that might alert authorities to the money's criminal origins. They ignored internal compliance alerts and failed to implement even basic anti-money laundering procedures. The consequences of HSBC's willful blindness were horrific. The money they laundered funded drug trafficking operations that killed thousands of people in Mexico and fueled addiction epidemics across North America. Drug cartels used the clean money to purchase weapons, bribe officials, and expand their operations. One of the most tragic aspects of this scandal was revealed in lawsuits filed by families of cartel violence victims. These families argued that HSBC's money laundering directly enabled the violence that killed their loved ones. By providing financial services to drug cartels, the bank became a partner in their criminal enterprise. The bank's Mexican operations were particularly problematic. HSBC Mexico failed to monitor billions in cash deposits and wire transfers from obviously suspicious clients. The bank's anti-money laundering systems were so inadequate that they failed to detect patterns that should have been obvious to any competent compliance officer. But the problem wasn't limited to Mexico. HSBC's U.S. operations also failed to properly monitor correspondent banking relationships with Mexican institutions. The bank processed billions in wire transfers from Mexican banks without conducting adequate due diligence on the ultimate sources of the funds. When U.S. authorities finally investigated, they found that HSBC had systematically violated anti-money laundering laws and Bank Secrecy Act requirements. The bank had failed to implement proper compliance procedures, ignored obvious red flags, and actively facilitated money laundering by editing transaction records. In 2012, HSBC agreed to pay $1.9 billion in fines and entered into a deferred prosecution agreement with U.S. authorities. The bank also agreed to spend over $1 billion upgrading its compliance systems and accepted ongoing monitoring by independent experts. But many critics argued that the penalties weren't severe enough. No individual executives were criminally prosecuted, and the bank avoided felony charges that could have costed its U.S. banking license. The settlement was seen as evidence that some banks are too big to prosecute criminally. Liberty Reserve Scandal. While traditional banks were being used to launder money, criminals were also creating their own financial systems. Liberty Reserve, operating from Costa Rica between 2006 and 2013, became the world's largest digital currency money laundering scheme, processing over $6 billion in criminal proceeds. Liberty Reserve marketed itself as a digital currency platform that offered privacy and anonymity. Users could create accounts with fake names and email addresses, transfer money instantly across borders, and convert between different currencies without any identity verification. For criminals, it was like PayPal without any of the inconvenient legal requirements. The platform attracted over 1 million users from around the world, but it wasn't families sending money to relatives or small businesses facilitating international trade. Liberty Reserve became the preferred payment method for hackers, identity thieves, credit card fraudsters, and drug dealers. If you wanted to monetize cybercrime, Liberty Reserve was your bank. Here's how it worked. Let's say you're a hacker who stole 1 million credit card numbers. You can't just deposit the money you make from selling those numbers into a regular bank account because that would create a paper trail leading back to you. Instead, you use Liberty Reserve to receive payments from other criminals who buy your stolen data. The beauty of Liberty Reserve from a criminal perspective was that it operated entirely outside the traditional banking system. You could open an account with a fake name like Mickey Mouse using a disposable email address. There was no identity verification, no government reporting, and no cooperation with law enforcement. The platform used its own internal currency called Liberty Reserve Dollars that could be exchanged for real money through a network of third-party exchangers around the world. These exchangers, many of them operating illegally, would convert dirty Liberty Reserve dollars into clean cash or legitimate bank deposits. Liberty Reserve's founder, Arthur Budovsky, was a Ukrainian-American who had previously been convicted of operating an illegal money transmitting business in New York. Instead of learning from his legal problems, he simply moved his operation to Costa Rica, where financial regulations were weaker and law enforcement cooperation was limited. The platform's criminal clientele was diverse and international. Russian hackers used it to receive payments for stolen credit card data. Nigerian scammers used it to collect money from their victims. Drug dealers used it to receive payments for online drug sales. Ponzi scheme operators used it to move money between different fraudulent investments. U.S. authorities spent years investigating Liberty Reserve, working with international partners to map out the network of users and exchangers. The investigation revealed that the platform was processing virtually no legitimate transactions. Nearly all of its business involved criminal proceeds of one kind or another. In May 2013, U.S. and international law enforcement agencies coordinated a massive takedown operation. They arrested key figures in Costa Rica, New York, and other locations, while simultaneously seizing Liberty Reserve's servers and shutting down the platform. Arthur Budovsky was extradited to the United States and sentenced to 20 years in federal prison. The platform's chief technology officer received a 5-year sentence, and other key figures faced similar penalties. The takedown was hailed as a major victory against cybercrime and digital money laundering. Did you enjoy this breakdown? Then please subscribe and hit that bell for part 2.